Okay, so the election is less than a week away, and major binary events like an election offer many different kinds of opportunities for options traders. I'm Seth Freuberger, the head trader of SMB Capital's options trading desk here in Manhattan, and the professional traders on our desk are aware of market tendencies around binary events and how to trade them using option strategies. Now, in today's video, we'll be teaching you a simple option strategy for a weekly options trade that can be very rewarding in the right circumstances, so stick around if that sounds like something you'd like to add to your playbook of trades. Hi, I'm Seth Freuberger, and I'm the head trader of SMB Capital's options trading desk. SMB Capital is a proprietary trading firm located in Midtown Manhattan, and we provide capital for options and equity traders from all over the world, trading both remotely and in our offices here in New York City. Now, I'd like to suggest that you click on our subscribe button right now so that you don't miss any of our free trading videos that we produce for traders and investors all over the world. They're really very valuable. Okay, so we're now less than a week from the U.S. presidential election, a historic election which has massive ramifications for the world economy in so many well-known respects. And so there's a tendency before certain binary events like a presidential election for the market to basically go into a pause, essentially trading in a channel awaiting the election results before making a move to either break out to the upside or break down to the downside as the market tries to digest the meaning of the election results. And so, as we've reviewed in other videos, if we look back at, for instance, the 2016 election, you'll see that the market for over 4 months was channeling in the 2100 to 2200 range, which makes sense as the election outcome was unknown and the market in general didn't want to get ahead of it. Of course, after that, the market broke out to the upside, but prior to that, it's easy to forget how tentative the market was. So if we move now to 2020, we're in the midst of a pandemic, and so the range is much larger now, between 3,200 and 3,600, but the market is flagging near its all-time highs, having recovered from the pandemic lows of mid-March. Well, in this kind of a circumstance where the market is trading in a range, expecting some upcoming event to push the market out of that range, there are a family of option strategies that can prosper in a situation like that if you're familiar with them. Now, most of you are probably familiar with index options, which are the options that we'll be using in this video to explain this trading strategy. But there may be some of you who just have a passing knowledge of how they work, so I'm going to do a really quick review of the basics so that you'll be able to understand this strategy. For those experienced options guys out there, don't worry, this is going to be quick, and we'll jump right back into the guts of the lesson. So you're probably all familiar with how equity options work. With equity options, a call buys you the right to buy 100 shares of a stock at the strike price of that option anytime before the option expires, and a put option entitles you to sell 100 shares of stock at the strike price of the put before that option expires. But there are also index options, which work similarly to equity options, except that there's no such thing as 100 shares of an index like the S&P 500, so you can't really buy or sell 100 shares of an index, but what you can do is get paid cash, $100 per point if the index expires above the strike price of an index call that you buy, or alternatively, you'd be paid $100 per point for each point the index drops below the strike price of your index put. So for example, if the SPX index is trading at 3,000 and you buy the 3010 call, if the SPX goes to 3015, you'd receive $500 of cash in your account. If the index closes at 3010 or lower, your call expires worthless. On the other side of the ledger, if you buy a 29.85 put and the market sells off to 29.75, you'd make $1,000. But if the market just sold off to 29.85 or higher, the put would expire worthless. So those are the basics of index options. So with that understanding, let's move now to October 16th, which is less than 3 weeks from the election, and you can see that the SPX is trading around 3,500. So let's say on that day we decided to implement a strategy assuming that the market would stay in a relatively tight range in the weeks leading up to the election. So what we can do to initiate this trade is to sell 3 of the 3,500 calls while simultaneously selling 3 of the 3,500 puts, both of them expiring a week from now. We'll then buy as protection 3 of the 3,590 calls in the same expiration chain 90 points higher while simultaneously buying the 3410 puts 90 points below the short puts for protection in the event of a market breakdown. Now, this entire combination is known to options traders as an iron butterfly, and it can produce very high returns when the market trades in a small range. Now, before we get into how this trade plays out, which is going to take a bit of a twist as you're going to see in a minute, I wanted to let you know that beyond what we're teaching you in this video, there are a large number of sound, viable long-term techniques for trading options for income. And in that regard, we're currently running a 2-hour free intensive workshop where we'll be teaching you 3 of those strategies that real professional options traders use. In that webinar, we'll be teaching you a really simple but incredibly effective strategy that some of the greatest investors in the world, like Warren Buffett, use all the time, plus an options trading strategy that has a statistical 80% probability of profit month in and month out, plus an option strategy that you can employ with a stock that you like where you'll make your target profit whether the stock goes up, goes nowhere, or even goes down a small percentage. So if you'd like to learn these strategies, then just go ahead and click the link that should be appearing now at the top right corner of your screen. That's going to open up a free registration page in a new window, so don't worry, you won't lose this video. Or you can register for the workshop at optionsclass.com. It's not often that retail traders can be taught strategies employed by actual Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now and don't miss it. Well, focusing first on the short options, we've sold 3 of those 3,500 calls for $37.85. And remember, each call represents $100 per point above 3,500 on expiration days. So we multiplied the $37.85 price by $100 and we sold 3 of them. So you multiply that by 3 to get the total cash flow from the short calls of $11,355. And you can see with the $35.81 price on the 3 short 3,500 puts, we collected $10,743 for those. Then in turn, we pay out $19.38 and $11,850 for the 3 calls at $35.10 we bought for upside protection, and the 3 34.10 puts we bought for downside protection, respectively. So when you net it all down, we received initially $16,821 of cash inflow from entering into this iron butterfly trade. And incidentally, your broker would require you to have a little over $10,000 in your account, as this is the maximum risk of the trade. Now, before we move on, I'd like to point out something really important, and that is, if you think about it, on expiration, either the short calls or the short puts are going to have to make a payout to the ones who own those options, the ones we sold those options to, and who paid us all that money to buy them. And the reason is that unless the fluke of all flukes occurs and the market closes exactly at 3,500 on the day these options expire, then the market logically has to be either above or below 3,500, one of the two. And therefore, one of the 2 options will pay off. But we've collected so much money originally on this trade, over $16,000, that the options which pay off, either the short calls or the short puts, as long as they don't pay off too much, then there will be cash left at the end of the trade from the original $16,000. And that remaining cash represents your profits on the trade. And so options software provides you with a pictorial version of how that plays out on what are called risk graphs. And as you can see, the market could go as low as 34.43 before the put options pay out so much that we run out of the original $16,000. And the calls could pay out up to a closing price of 35.56 before the payout on the short calls would exhaust the original cash that we received. And so this graph represents the amount of profit you'd make between those 2 prices. And the closer you are to the center, which is 3,500, the less either the call or the put would pay out, and therefore the more money you'd make, which is why the profit levels rise towards the center of the graph. The reason that I've pointed this out is that if the SPX index does move to one of those upper or lower extremes, then our strategy states that we will do something to alter the trade, specifically to widen out the range over which we'll make profit. And that adjustment is normally made when either the upside extreme, 35.56, or the downside extreme, 34.43, is exceeded. So now let's move forward to 3 days later, to October 19th. And as you can see, the market has sold off below 34.43. So as we mentioned earlier, this is going to trigger a downside adjustment on our part, because remember, below 34.43, if the market were to remain here, we would lose money on the trade unless we do something. So let's first look at what we'll be doing at this point. And as you can see, we'll be buying back those 3 short puts at 3,500, which closes that position, because when you buy the same number of puts that you're short, then the position just turns to 0. It disappears, and there's no position there. Then we're going to move down to the 3 long puts at 34.10, and we're actually going to be selling 6 of those, which will turn that long position at 34.10 into a short position. We'll become short 3 options there because we're selling 6, yet we only had 3 long ones there in the first place. And finally, we'll go down another 90 points to 33.20 and buy 3 of those puts. And so when we're done, the position looks like this. Now, let's look at our cash flow situation after this put butterfly adjustment. So first off, we need to start with the initial cash flow in the trade, which was the net proceeds of the original iron butterfly, that's $16,821. And you'll see that buying back the 3,500 puts was really expensive because the market had moved down so much. But then we're able to sell the 34.20 puts for a nice amount of cash, and then we had to pay for those protective puts down at 33.20, which was an expense. So when we net it all down out of the original $16,000, we're still left with a little over $7,000. And because of margining rules, your broker will require a little more capital from you at this point in the trade. And as you can see, that requirement has risen about 20% to a little over $12,000. Now, remember, this is a 1-week trade. So let's move forward now to 1 week later, the day that it expired. And you can see that the SPX closes at 34.65 on that final day for trading of these options. And so on options expiration day, your broker will assign a final value to each of the options that are expiring. So let's analyze how that played out. Well, focusing on the calls, you can see that both the 3,500 and the 3,590 calls are well above where the market closed. And those, of course, have no value unless the market closes above them. So they have no value at all upon expiration, and they just expire worthless. The same is true for the 34.10 and the 33.20 puts, as well as the SPX index expired well above the strike prices of those options, which only pay off if the market closes below them. And so whether we were short or long, all of the options expired worthless, which means that we neither have an obligation to pay anyone cash, nor does anyone have an obligation to pay us any cash. The whole trade just dies. But remember, after that put butterfly adjustment that we showed you, we had over $7,000 in cash left over from the original cash we got for selling the iron butterfly at the beginning of the trade. Well, we get to keep that cash because, again, we aren't obligated to pay any of that out because everything expired worthless. So that's not bad, right? As you can see, that constitutes a 60% profit in a week. Okay, so what I don't want you to take away from today's video is that you're going to make 60% return every time you make a 1-week iron butterfly trade adjusted by a put butterfly. Rather, it's more nuanced than that. What made this trade successful was the fact that even though the market made an outsized move to the downside shortly after we initiated the trade, this trade, which does best in a very calm market, was not at all a lost cause. That's because we had at the ready a repair strategy, or what options traders call an adjustment strategy, that increased our chances of making a profit by widening out the trade so that after the adjustment, the put options were well below the market and the call options were well above the market, giving us a large zone in between where we'd really make a strong profit if the market ended up within that very wide zone. And so it was more important that you had the expertise to handle the market moves than it was for the market to act exactly the way you would have wanted it to based on the original trade. Once you learn how to make simple moves like this on options trades, it opens up a whole new world of possibilities on how to trade options for income. Now, just to remind you, as I said earlier, if you enjoyed this video and learned something valuable from it and would like to learn the details of 3 real-world option strategies that professional options traders use all the time, then you should check out the free options class that we're currently running. Just go ahead and click the link that should be appearing now at the top right corner of your screen. That's going to open up a free registration page in a new window so you won't lose this video, don't worry. Or just head on over to optionsclass.com to register for this free intensive workshop. It's a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you're getting by attending this free online workshop. So click the link to sign up now and don't miss it. And please don't forget, click on the subscribe button right now so you won't miss all of the free trading videos that we're posting constantly on our channel to help you improve your game as a trader.